Hello, everyone. I'm Todd Rosenbluth. I head up the ETF and mutual fund research at CFRA, and I'm really excited you're here to join us for the Don't Overlook the Middle of the Market, a webinar tied to mid-cap investments. Joining me, as you'll see on the next slide here, is Matt Bartolini. Matt heads up the Spider America's research efforts for State Street Global Advisors. Matt, thanks for joining me.
Great to be here, Todd.
Glad to have you here. We're going to just, on this next slide here, just lay out the agenda for our attendees, and then we'll soon after move into it. So I'm going to cover the landscape that we have, not only for ETFs, but for mid-cap investing, reminding the audience about the way that CFRA covers not only individual stocks, but ETFs connected to that coverage on stocks. Matt's going to be back to join about a discussion about mid-cap investing, why we at CFRA and State Street Global Advisors thinks that it's an under-covered part of the marketplace despite strong fundamentals. Then we're going to just show you some of the commentary that we've written about this space, and then take your audience questions. And I'd encourage you, starting now, if there's things you have in top of mind that you'd like us to talk about during the Q&A portion, to submit those. You can see a box showing up right there. So I do this on every webinar that CFRA hosts tied to ETFs, and it's a good reminder of how the year is progressing. We're at over $4 trillion in ETF assets. It's largely an equity ETF market. It's been that way historically. You can see U.S. equities being more than half of that pie, international being a healthy chunk of it, and roughly 20% is tied to fixed income. But actually we've crossed the $200 billion mark of net inflows during the year of 2019, and the majority of that has actually gone into fixed income ETFs. They're certainly punching above their weight. We certainly saw in September a return to taking on risk in the equity marketplace, and U.S. equity ETFs in particular saw strong demand. We'll see if that continues in the fourth quarter. It's not been a great start for equities, but the market's been volatile, and we'll see what comes. On this next slide here, it is and remains a market cap weighted way of investing using ETFs. So this is market cap weighted ETFs that is now $3.2 trillion in assets. I wanted to just look back 3 years ago. You can see we've nearly doubled the asset base in market cap weighted ETFs. And that's really happened in part because of asset allocation oriented products gaining ground. These well-diversified, relatively low-cost products that are being used by financial advisors, by institutional investors, by retail investors to get broad diversification. What has not happened here is we haven't seen a shift in where that money has gone. It has primarily been in large caps and then what we're referring to as broad caps that are covering the various spectrums. And mid-cap, and to a lesser extent small caps, are considerably smaller slices of the overall pie. Hopefully with this education that we're doing here through this webinar, you and others will get a better sense of what you're missing out if you don't have much mid-cap exposure. Let's move here to the next slide here about the flows and what's been happening in the past year. You can see, again, the money has consistently gone to large and broad cap strategies. Mid-caps have been that steady demand in the past year as opposed to small caps that had outflows in 3 of the 4 most recent quarters. And, it's nice to see that the money continues to move into mid-caps despite up and down markets. Certainly we saw, in the third quarter, we saw much more volatility. In the broader market, we saw more volatility in the fourth quarter of the year. But mid-caps, again, we don't think are necessarily getting enough of the overall market share here. Now, we've talked about mid-caps. We'll see here on the next slide about mid-caps in relation to small and large caps. But Matt, I want to bring you into this conversation because I think you can do a good job of explaining how mid-caps stand out versus large and small caps.
Thanks, Todd. Yeah, so what we have here on the screen is your traditional S-curve of potential growth for companies as they move along their maturation phase throughout their different life cycles. And what we like to sort of showcase is that, large caps, they are mature. They are multinational businesses with typically more diverse revenue streams. They probably have more bureaucracy within their organization too, just from a top-down perspective. legal departments are more formalized, compliant, et cetera. There's more of a structure associated with large caps, and typically what you think sort of blue chip type companies with that diverse revenue base. Small caps are different. They're unproven. They offer the room for growth. They have more of an entrepreneurial spirit to them, where the future growth is much higher than what they're actually being able to generate today in terms of cash flows. Now, mid caps actually sit in that middle spot. They have the managerial maturity where they may have, more of a technology stack within their organization. Compliance teams are probably starting to be built out. These sort of things we take for granted as a company matures, but are inherent in a more mature actual company with a more ongoing concern. So they have that managerial maturity, but they also have the operational dexterity of small caps. They are more nimble. If we look at things like revenue per employee is quite high in large caps, and in small caps it is much different. In mid caps, sort of strikes that balance, and that's what we're sort of talk about. There's the employee base has started to increase, their cash flows have become more consistent, and you start to see these small caps graduate up into mid caps and strike that balance between growth and stability.
Thanks, Matt. So on the next slide here, what I wanted to do was put some names behind the mid-cap space. So what we're showing here are some of the mid-cap companies that are in the S&P Mid-Cap 400 index that we at CFRA have a qualitative buy or strong buy recommendation. I've listed the market capitalization, I've listed obviously the name and ticker, and the sector. And we'll come to what the importance of the sector in a moment. But there's a range of companies, some you may be more familiar with than others. Old Dominion Freight Line, I'm starting to see pop up on my TV when I'm watching sporting events. They're advertising now. This is a company that we have a buy recommendation on. Our industrials team analyst believes it's got double-digit earnings growth potential in the next 3 years. Jumping down a bit, Pilgrim's Pride, the ticker on that is PPC. Apologies for not including the ticker. PPC is the ticker. This is a stock that now has an $8 billion market cap, but the stock has nearly doubled in 2019. This is in the consumer staples space. Chicken and other poultry products are offered, a number of different labels that are there. We still think that there's still significant upside to be had within this company. Another one I would highlight is Five Below. This is a consumer discretionary company. We at CFRA think it's going to have close to 30% earnings per share growth over the next 3 years for the specialty retailer. You'll see a lot of growth potential with these companies, but also these are companies, as Matt mentioned, that have the stability. Lastly, you see the sector diversification. So there are companies that are attractive from a valuation and a fundamental perspective across the gamut. It isn't just technology, it isn't just the consumer stocks. There's a wide range of stocks that we at CFRA cover that are part of the mid-cap oriented ETFs and that we find to be continue to be attractively valued. On the next slide here, just to again remind you about the way that we at CFRA are rating ETFs, how that is different than mutual funds, and how it connects with our stock research. So we have coverage on about 1,500 ETFs. The vast majority of that, like the vast majority of the products, are equity-oriented products. We use the analysis that I showed earlier about the valuation and risk characteristics of the stocks to help us drive our ETF research tied to equity ETFs. For fixed income ETFs, we're doing credit quality, duration, and yield to give more of a holistic view of the risk-reward potential. We cover products that are relatively new. Close to 30% of our coverage universe has launched within the last 3 years. We think you can do research on relatively new ETFs when you've got holdings to work with and you've got costs to be able to go off of. I won't spend too much time on the lower half of this other than to say, unlike Morningstar, we treat ETFs compared to ETFs and mutual funds versus mutual funds. And so there's a different metrics that are tied to that what we focus on for mutual funds, including the track record, including different cost metrics like turnover. On the next slide here, it just paints a little bit more of a picture of how we think we're different from a forward-looking perspective, how we leverage our fundamental research team of 75 equity and accounting analysts, why we think risk-taking needs to be recognized within an ETF, and why costs have long been a part of the way that we've been doing research on ETFs. So we include the expense ratio and the bid-ask spread, which we think can weigh down the returns of an ETF. On this next slide here, just a last thing, if you've been on prior webinars, you would know this, but in case you missed it, CFRA made an acquisition in August. We now have our own proprietary ETF data and analytics with the acquisition of First Bridge Data. You can see on the bottom half how we're going to be integrating that, and you may want to be able to integrating this yourself directly in a feed for ETF holdings, for classification data, core statistics. We're really excited to have the First Bridge team be part of CFRA and to show that we're continuing to invest in the growing ETF marketplace. With that, let me bring Matt back in. For those of you seeing this on the screen, these are some of the topics that Matt and I are going to cover. I won't read the slide in depth, but I'll just start off with the first question, Matt, and then we'll move through the rest of the presentation for you to just lay out how the fundamentals for mid-cap companies are comparing to the large and small cap companies. We touched on how they are different in the life cycle, but let's talk about the fundamentals.
Sure. So, I think really the first way to examine this is right here on this chart. And the fundamentals reinforce this idea of more stable growth profile than small caps, but higher growth than overall large caps. That sort of fundamental dexterity that we were talking about. And one of the ways to look at it is just by examining certain quality metrics from a balance sheet perspective. And the chart on the right-hand side shows debt to assets, so amount of leverage on a company's balance sheet, as well as those return on assets. And what we see from looking at this chart is that small cap stocks typically have a higher amount of leverage. They're taking on more debt relative to their assets. Meanwhile, mid caps are actually below that of actual large caps on their debt to assets ratio. So they're actually taking on less leverage than large caps. But at times, we look at this on a time series basis in a chart, they're actually sort of trading back and forth with each other. So when we think about the operational structure of mid caps and large caps, they're very similar. And they also have a higher return on assets. They're able to sort of generate more fundamental growth than small caps. The other side of this is operating margins. So operating margins are a traditional indicator of how well a company is being managed, depicts basically the proportion of revenues available to cover non-operating expenses, and it can show, again, the fundamental differences between large, mid, and small. So again, here, mid-cap stocks really fit within that middle space, which is sort of synonymous with the type of market capitalization spectrum that they're on. But what it also shows is that, perhaps relative to small caps, they have more of a going concern. Their cash flows are more normalized. They are more of a mature company, but they do not have the pricing power of a large cap that maybe is able to bundle services together and create extraordinary more brand loyalty within customers that then allow to charge for higher fees and higher revenues and more sort of efficient in their usage of capital. So what these two sort of quality metrics show is that mid caps offer the stability and balance sheet strength of large caps. And on the next slide, what we're actually able to show is the growth potential of small caps. So once again, we're going to look at the fundamental metrics over a long period of time to showcase the differences between large, mid, and small. And what we like to showcase here is this sort of the orange bar on the right-hand side is basically the standard deviation of earnings per share growth of mid caps. The volatility of their earnings growth, is actually below that of both large and small, but sizably below that of small caps. So that sort of underscores the sort of stability aspect of mid caps relative to small. On the left-hand side, again, if we look at the orange column, this is the average earnings per share growth of mid caps. Mid caps represent a higher growth, so the average earnings per share growth is higher than that of large caps. But below that of small caps. Again, small caps tend to be higher growth because the future growth prospects are much higher given that their businesses are yet to be unproven, and potentially it may be sort of a unicorn type company that goes on to build a more loyal customer base with stronger revenues. So taking these last two slides together show that mid caps have a balance sheet quality nature similar to of large caps, the more stability, which goes along with a company that might be a little bit more mature in its life cycle. However, it doesn't sacrifice that much from a growth perspective because their average earnings per share growth is similar to that of small caps. So it's really one of the reasons why we refer to mid caps as sort of this sweet spot between growth and stability.
Thanks, Matt, for that. We'll move here to the next slide. And what this is interesting to me is that despite it being the sweet spot, as you mentioned, for investing, it tends to be overlooked. There's a number of companies within the space that just are under the radar for many investors. This is something that we've long thought, but I think that you've got some great data here in terms of from an academic perspective and an analyst perspective.
Thanks, Todd. Yeah, so we wanted to understand why there was this bias or aversion to mid-caps because, as we showed earlier, it's not the fundamental makeup of it that are deterring investors from allocating to mid-cap companies. You showed earlier the breakdown based on ETFs. If you extend that to mutual fund assets, there's more assets in the small cap space than there is mid-cap, which if investors are allocating based on market capitalization from large, mid to small, you would think it would be otherwise, that mid caps would have a higher amount of total investable assets than small caps. And what we find is that that's not true. And so why was this bias formed? And we landed on this theory and notion that they're overlooked and undercovered. And they're overlooked by a fundamental analyst community, as you see here on the left-hand side. We look at the average analyst coverage, so basically the number of analysts that are covering a single stock within each type of market capitalization structure. Naturally, small caps are at the least covered, which is one of the reasons why they potentially may have a premium associated with them over a very, very long time frame. But relative to large caps, mid caps are also overlooked. And it's not just as a result of one sector, it's actually throughout every sector that there are more analysts covering large caps than there are mid caps. So they're overlooked by the fundamental analyst community, but also the academics are not looking at them as well, right? So undercovered in terms of academia. So academics, based upon the seminal work of Eugene Fama and Kenneth French back in their 1992 paper, a lot of academics really enjoy and like researching these potential small cap premia. So what we want to showcase here is, okay, so if fundamental analysts are overlooking mid caps, what are academia doing? And we find that we do a search result for a small cap or small stocks paper on a research website, so SSRN. So it's a great website for sort of white paper research. And what we see is that small cap and small stocks are very heavily researched by academia. Meanwhile, mid cap or middle stocks are not. So we were able to form this theory that there is a bias associated from two investment communities, both fundamental and the academic analysts. And I think that's probably one of the reasons why you see a hesitation around investing is there's just not a lot of information in regards to mid caps.
So I wanted to just add an example. So I touched on Pilgrim's Pride within the consumer staples space. It's a stock that we at CFRA cover. It's a stock that we have a favorable strong buy recommendation on. CFRA is one of 11 analysts that are covering that according to Capital IQ consensus data. There are 21, and this is a packaged food company. There are 21 analysts, including CFRA, that are covering Kellogg, a large cap packaged food company. So again, even though we've seen stronger returns for Pilgrim's Pride this year, it's still remaining under the radar for investors. So we've looked at it from a fundamental perspective. We looked at it from a coverage perspective. Matt, let's move as we move to the next slide here to just talk about people tend to use mid-cap investing in a diversified way. What are the returns showing from a risk-adjusted basis?
Returns are strong, and we wanted to showcase the persistency of it because everyone can sort of look at a cumulative growth chart of both large, mid, and small and see that mid caps have handily outperformed both large and small over the last 25 years. But we wanted to show that there's a persistent nature of mid-cap stocks performance relative to both large and small. And we ran multiple different screens, but one that we are showcasing here is basically looked at a batting average or a hit rate. And we wanted to look at the percent of periods on a rolling 5-year basis to sort of navigate different market cycles, going back to 1994. So that gave us 242 different unique 5-year rolling periods. And we compared the performance of both mid-cap stocks to large and small. And we found, as shown here, relative to just basically core strategy, like S&P 400 index, 68% of the time on those rolling 5-year periods, mid-caps were outperforming large caps. And when we look at it versus small caps, it's 57%. And when we dive a little bit deeper and break it out by growth and value, the performance even gets even better. So 80% for both, or 80+% for both when we look at it versus large and small. Now, we wanted to then isolate this to see if it was a result of taking on excess risk. So we looked at two different risk measures, one being the Sharpe ratio, the other one being Sortino. Sortino, for anyone that's following along, it looks only at downside deviation, so negative volatility. It doesn't really punish you for having positive volatility, which can actually result in positive returns. But either way, when we looked at it, there are strong results of mid-cap stocks relative to both large and small, where even an S&P 400 growth, when we look at it versus small cap stocks, small cap growth stocks, 100% of the times mid-cap outperformed on a risk-adjusted basis, whether it's through Sharpe ratio or Sortino. And then we actually went a step further and analyzed, well, how many times were mid-caps having stronger risk-adjusted returns than large and small at the same time? And if we look at just the S&P 400, over the 242 rolling periods, it was more than half, so 53%, which you'd say, if you stack it up, mid-caps had the best hit rate because based on math, no other market cap segment could be better than 50%. So this return persistency was really strong, and it's something that we wanted to get across to investors when thinking about asset allocation strategies because of the asset totals you referenced earlier, that they continue to be underweight mid-caps, even though the returns and fundamentals portend to a very robust market environment for mid-caps.
So, Matt, realizing this is an ETF webinar, we at CFRA do research on both ETFs and mutual funds. On the next slide here, I think it's easy for someone listening to this to go, okay, let's have an actively managed mutual fund tied to mid-caps to be able to deliver this rather than my doing it using an index-based approach. This data certainly highlights the value of using an index-based approach.
Yeah, so basically a misstep in implementing a mid-cap strategy can be almost as detrimental as not including mid-caps at all. And that's what we look at here is basically a percent of funds outperforming their prospectus benchmark on a rolling 5-year basis, so active managers. And basically since the crisis, the median active manager has been, basically the median hit rate has only been around 25%, 22%. So there's been a significant amount of active managers who have not been able to outperform their prospectus benchmark. And if we look at just even over the past 10 years, only 7% of active managers in the core strategies, so blend from a Morningstar perspective, have actually outperformed their respective benchmarks. So the hit rate is not great. And the average manager excess return in core strategies over the last 10 years has been negative 2%. So a lot of the due diligence will lead you to believe that you would want to go towards an index-based strategy. In the research report that we wrote, we did sort of identify that there's an area where maybe active management may work well in terms of growth-oriented strategies, given hit rate, as well as the persistency after controlling for expenses. But lately, growth managers haven't fared well. If we looked at the third quarter, only 15% actually outperformed their respective benchmark for all different types of capitalizations. So really, when it comes down to it, if you've identified that mid-caps are an attractive area, index-based strategies may be the best way to go because you can sidestep any potential underperformers by selecting the more incorrect or sort of alpha inability to generate manager.
So, and again, the performance data should speak for itself, and 25%, 22% is just not a way of going at it. You certainly want to be close to 50, if not above 50%, which is where we saw things, a decade or so ago. On the next slide here, I just want to lay out a couple of other benefits of using mid-cap ETFs relative to mutual funds. And again, a reminder, we cover and have research on both mid-cap ETFs and mid-cap mutual funds, but we wanted to highlight some of the additional benefits. So from a style purity perspective, when the index, whether it's the S&P 400 mid-cap index or others that are out there, are reconstituted as the stocks become too large or too small, without necessarily having style drift or market cap creep. So for example, there are stocks that on a regular basis that get moved out of the S&P 400 mid-cap index, they become too big and they graduate to be part of the S&P 500 index. There are companies where the fundamentals have weakened, the valuation has struggled, and they get moved from the 400 to the S&P 600 index. That's cleaning that up yourself, or the index is cleaning it up itself, rather than you having to do that or the active manager having to do that. The sector diversification I touched on earlier about the coverage that we at CFRA have from buy and strong buy recommendations, but the double-digit representation across industrials, technology, financials, consumer discretionary, and real estate, being a little surprising given how small real estate happens to be within the large cap index. It's 11%. And then cost. Part of the challenges that active management has in keeping up with an index is that fee. The average mid-cap core mutual fund in the research that we here at CFRA charges 120 basis points. There's a wide array of ETFs that are available that charge 25 basis points. At the risk of a plug here, Matt, what are some of the examples that what State Street offers in the mid-cap space that would meet this threshold?
Yeah, so we have a full suite of mid-cap strategies that to some extent extend beyond just pure market cap weight, because the way we construct our industry funds that cover things like biotech and pharmaceuticals, they're equally weighted, so you actually get a higher weight into mid-caps overall. So we sort of take that practitioner's approach, even when thinking about how to create products and sort of harness potentially some of these benefits we've been discussing about throughout. But from a pure market cap perspective, we have funds that are built for liquidity or have robust amount of liquidity, like an MDY, with trading volume and optionality. So option contracts tied to it are quite high. There's a lot of notional value there. But then we also have low-cost products. So a product like SPMD, which is full market capitalization weighted, mid-cap oriented stocks for a very low overall expense ratio, around 6 basis points. But then also, like we said earlier, there's persistency to this growth and value structure. So offering both growth and value mid-cap exposures allows investors to benefit from asset allocation differences by overweighting or underweighting one based upon their viewpoint in the marketplace. So we like to offer a strong suite into the mid-cap space, just given the research that we've done to it, and I think it'd be a benefit or potential benefit to portfolio allocations.
Thanks for that. So we at CFRA are covering those products. I wanted to show you on the next slide a couple of ways that we are covering ETFs and covering mid-cap ETFs in general. On the right-hand side is a sample of one of our ETFs that we have under coverage. This is MDY. Matt mentioned earlier, this is the longer standing of those mid-cap products that has the greater institutional and greater liquidity behind it. You can see how we are rating the ETFs, and we can give you more color. And if you have interest in this ETF and want a sample report, please let us know in the chat box. On the left-hand side is a thematic commentary piece that we wrote, which was tied to promoting this webinar. So you might have seen this about not overlooking the middle of the market. We covered some of what we touched on in this webinar. This is an example of thematic research that we at CFRA publish 2 or 3 times a week, covering the ETF marketplace. And again, this is a summary of the white paper that Matt and team did that is available on State Street Global Advisors' own website. On the next slide here, and hopefully you're getting this, if you are not currently receiving CFRA's weekly newsletter, rather than you having to go to the platform, MarketScope Advisor platform directly, what our team does is grab some of the more popular pieces within a given week from both an investment strategy perspective, from an ETF perspective, and our stock analysts that are industry experts. And on the beginning of the week, you'll get a copy of this newsletter with clickable links that should bring you back to the MarketScope Advisor platform. Really excited of the work that our marketing team put together on this, and hopefully you're enjoying the content. Here, I just want to again remind you that you hopefully have submitted a question. We got a number of questions that came in. Due to the great content that we provided, we'll probably touch on a couple of them now, but what I would say is we will certainly follow up with you. We had a prior webinar that we did on active fixed income ETFs. We got a whole host of questions that came in, so many that we couldn't get to, that in addition to sending it out to all attendees, I published a research article, a thematic research article answering those questions so that all attendees could be able to do that. But Matt, I want to take the first one that seems more appropriate for you in talking about, you touched on it, but maybe we can go more in depth about the impact of adding mid-caps to the portfolio. What can that do?
So just looking at the return streams we showcased, obviously historically, it would have led to higher returns with lower volatility. When you think about just supplanting mid-caps into the equation if you didn't have any earlier. And we looked at it from a returns or Sharpe ratio perspective. So that's sort of one starter there, is that it historically had led to allocating to a portfolio higher risk-adjusted returns, but also higher absolute returns. But one of the things that we looked at, which is available out on our blog to read, is what happens if you start to include it in more tactical strategies. So we utilize a rules-based approach known as dual momentum, and we followed the rules, and what resulted was, again, but more starkly so because you're more tactically going in and out of mid-caps as a result of large and small and their price performance, you had the magnitude of returns was increased, and the magnitude of your sort of risk-adjusted characteristics was also increased. So the big takeaway is that it can be additive to the portfolio, both from a return perspective, but also risk mitigation, depending on where you're pulling that capital from. If it's coming from small caps, you would think to have a lower volatility. If it's coming from large caps, you might have an increase in volatility, but potentially the return to obtain that volatility would be higher, therefore leading yourself to have higher risk-adjusted returns.
Thanks for that, Matt. So there's a question that I think both of us can tackle about valuation. So are you paying too much of a premium for the fact that these are undercovered companies? I want you to talk about this from a broader index perspective, but I would say that there's still great valuation opportunities. So we at CFRA cover 215 stocks within the S&P 400 index, which again highlights about how they may be undercovered. Even though we are covering many of them, we're not covering that much more than half of them. 28% of those 215 stocks are CFRA buy or strong buy recommendations. So 62 names we still think that we cover still have upside potential. Matt, historically, how have mid-caps traded and or how are they trading now, however you want to handle it?
Yeah, so again, we looked at this historically going back to 1994, and what we found is that from a valuation perspective, mid-caps trade at a discount relative to large caps, which likely reflects their excess risk of mid-caps. And then also mid-caps will trade at a slight premium to small caps, once again, sort of showcasing the excess risk that you take of moving further down the cap structure with small caps because from a valuation perspective, they tend to have sort of lower valuations than mid-cap. So they sort of firmly sit right in the middle from a historical valuation perspective, which is, again, synonymous with the name. But currently where they are, when we run a quantitative approach, which we feature in our monthly chart pack, mid-caps actually screen both relative and on an absolute basis as relatively attractive compared to other styles and regions. I think like Europe and emerging markets, et cetera. Emerging markets is one of the areas that probably screens the best, just given the return paths. But I think for investors that are concerned over valuations, taking a quantitative look can mitigate any biases at looking one or two different sort of price to book or price to earnings fundamentals. And currently mid caps, we think about the US, do screen as more constructive from a valuation perspective relative to large caps, which given their sort of growth and high tech exposure tend to be screening as expensive right now given the current market environment.
And so I would add that our investment strategy team also publishes on a weekly basis a scorecard about where the valuations lie for large, mid, and small, and growth versus value. And we also find that mid caps are trading at a attractive valuation multiple in relation to large and small caps. Excuse me. Sorry for mixing those names up. And so we, again, also think that there is great opportunity to have within the mid-cap space. There's a wide range of both individual stocks as well as ETFs that we are favorable on, that we touched on during this webinar, as well as for those of you that still, despite with the data that Matt shared, there are mid-cap mutual funds for those of you that want a more actively managed approach. I'm going to move us here just to the next slide. And thank you for everybody for your questions. Apologies for the sake of time. We aren't able to get to them, but we will follow up. We hope you join us for the next webinar that CFRA is going to be hosting tied to ETFs. I'm going to be joined by Anik Dalal, who heads up our ETF data and analytics. He headed up FirstBridge as a company. He was the CEO of FirstBridge. And what we've done recently is look back at the last 5 years, see where there's been winners and losers within the ETF space, both at an asset manager level, a individual ETF level, where we've seen closures. I think you're really going to find a great longer-term perspective on the ETF marketplace. This is taking place on October 22nd. There will be invitations, probably as a follow-up to this webinar, and thanking you for attending. But you can register. You can see how to do that on the bottom of the screen, which is on our ETF webinars page. And hopefully we'll get to hear more from you at that point. So with that, I want to thank you, Matt, for joining us. Thank everybody for moving through the presentation with us. I'm going to very quickly take you through the disclosures on the subsequent slides and say, Matt, thanks again for joining us here at CFRA. It's been a pleasure talking mid-caps with you.
Thank you.
Thanks, everyone.